Now the topic before us is current account versus capital account in the balance of payments. We have already learned that balance of payments is a systematic record of all the economic transactions which take place between the residents of a country and the rest of the world during a specific period. What it means? That in the case of balance of payments, we record many transactions. For example, we as a country do export of certain goods and services, and we also import goods and services from the rest of the world. We receive unilateral transfers in the shape of aid on humanitarian ground. We also give aid to rest of the world. We receive income investment in the shape of dividend from the rest of the world, and we also give payments to others in the form of dividend profits which goes abroad. We receive loan from the rest of the country. We also give loan to the other countries. We receive investments from abroad. We also make investments abroad. So balance of payment is a very broad concept, and balance of payment has three components: current account, capital account, and financial account. In the case of current account, we take into account export and import of goods, export and import of services, unilateral transfers, paid and received, investment income, paid and received. These are the four components of current account. In the case of capital account, we record the transactions which pertain to acquisition and disposal of non-produced and non-financial assets. Non-produced and non-financial assets are those assets which cannot be produced and where some intellectual work may be involved. Non-produced examples of non-produced and non-financial assets are land. We also take into consideration in capital account fishing rights, mining rights, other natural resources, and intellectual properties also taken care of in the capital account, such as trademark, logos, domain name. In the case of capital account, we also record transactions pertaining to capital transfers. If a country forgives its right to receive debt, it is recorded in capital transfers. So you can from here see that current account has four components, and the capital account is concerned with non-produced and non-financial assets and capital transfers. So now we will have a brief discussion about the difference between the two. Current account records pertaining to export import of goods and services, investment income, and unilateral transfers which take place between the residents of a country and the rest of the world. On the other hand, capital account deals with the transactions related to non-produced, non-financial assets and capital transfers. These assets are not created through production, and these assets do not directly generate income but have economic value. Current account pertains to goods, services, investment income and unilateral transfers, and capital account pertains to land, natural resources, intellectual property such as patents, trademarks, etc. Now the topic before us is current account versus balance of trade. We will now understand the difference between current account and balance of trade. In case of current account, we know that there are four components. What first is visible items, then come invisible items, then come unilateral transfers, and the fourth is income from investments. These are the four components of current account. Current account itself is one of the components of balance of payments. So when we are talking, we are here to understand the difference between current account and balance of trade. The balance of trade is only concerned with these two: visible items and invisible items. Visible items means goods which are can be seen, touched and measured. So these are called visible items. Invisible items means services which cannot be seen, touched, measured, and the examples of the same are shipping, banking, insurance, transportation, etc. Balance of trade is the difference between exports and imports. That is, exports minus imports is balance of trade, the value of exports minus value of imports. Here we are talking about exports of the country as a whole, imports of the country as a whole, all the exports which take place between the country and the rest of the world. So here is a brief overview of this. All is a brief overview of current account. As already told earlier that in the case of current account, we record transactions on the debit side and on the credit side. All the transactions because of which there is inflow of foreign exchange, they are recorded on credit side. If there is inflow of foreign exchange, all those transactions on account of which there is outflow of foreign exchange, they are recorded on debit side. When we export goods or export services, we receive foreign exchange, so they are recorded on debit side. When we import goods and services, there is outflow of foreign exchange, so they are recorded on debit side. When we make unilateral transfers, that is, there are one-time transfers also, that is, we may be giving aid to other countries on humanitarian ground. So these are one-time transfers for which no return is expected. We may be providing food, medicines to the rest of the world in case there is any humanitarian problem in any country of the world. So these are one-time transfers, unilateral transfers, for which nothing is expected in return. In the same way, when we receive unilateral transfers from the rest of the world on humanitarian ground, etc., then they are recorded on debit side because there is outflow of foreign exchange. If we give, it is unilateral transfer. When we give unilateral transfers, there is outflow. When we receive unilateral transfers from abroad, it is recorded on the credit side because foreign exchange comes into our country. When we receive income on investments in the shape of dividend, interest, etc., there is inflow, so they are recorded on credit side. And if we make payments or the foreigners receive payments for their investments in the shape of interest, dividend, profit, then it is recorded on debit side because there is outflow. So here, this is whole is current account. And if we are to talk about balance of trade is only concerned with only these two items. This is balance of trade. The difference between exports and imports. Now we will have an overview of current difference between current account and balance of trade. Current account is an account or one of the components of balance of payments where we record exports and imports of goods and services, unilateral transfers paid and received, and investment income received and paid. And all these transactions are recorded when they take place between the residents of a country and the rest of the world. On the other hand, balance of trade is the difference between a country's exports and imports of goods and services. If we say that balance of trade is only concerned only with export and import of goods, it is the narrower definition of balance of trade. It If we say that balance of trade is only concerned with goods, then it may also be called balance of visible trade. If we say that balance of trade is concerned only with services, it will be called as balance of invisible trade. So when we are talking about balance of trade, we will be taking into account both goods and services because this is the broader aspect. We cannot ignore the role of services in export and import of the country. Services play an important role in any economy. So when we are talking about balance of trade, we should have a broad overview and should also include services in the case of balance of trade. Now, what are the components of balance of trade? We have already discussed that visible items, invisible items, investment income and unilateral transfers are the components of balance of trade. And in the case of balance of trade, the components are visible goods, or we can simply say goods and services only. We do not take into account unilateral transfers and investment income in the case of balance of trade. We are only concerned with goods and services in case of balance of trade. Now, settlement. Current account deficit cannot be financed by balance of trade. What it means? When we record all these transactions, suppose it is 1000, it is 500, it is 200, it is 150, it is 100, it is 90, it is say 700, it is say 600. And when we make total of the debit side and credit side, what it means? What comes? It comes 2000, 1000, 700, 200 and 100. Zero, zero, no, 7, 1340. Okay, you can see that here inflow is less, whereas outflow is more. So here is deficit of 660. It is deficit minus 660. The figures are in negative. Here the difference current account is deficit. So whether this deficit can be filled by export of goods, difference between export and whether if we do exports, if we are earning more from exports as compared to say if the figures are more in exports, whether it can be met, this deficit can be met by here balance of trade. No, because we have already, this is the figure which is arrived at only by totaling debit and credit side. So here the deficit, if any, the current account cannot be met by balance of trade because balance of trade it itself a part of current account. But balance of trade, if there is deficit in balance of trade, it may be met, or we can say that other parts of current account can play a supportive role in mitigating the overall impact of deficit in BOT can be partially offset by other parts of the current account. What it means? It means that suppose there is a deficit in balance of trade. What it means? It means that if imports are more than exports, suppose this is the situation, what happens? We will have to pay. So these two parts, other parts of the current account can play a supportive role in reducing the impact of of current deficit of balance of trade. Suppose there is difference of say in export and import, there is difference of say 200. Suppose we assume that there are negative figures, imports are more as compared to exports. So these two items, unilateral transfers and income, can play some role in reducing this negative figure to some extent. But we cannot say that all of the negative impact of balance of trade will be absorbed by these two items, unilateral transfers and income. No, they can play only some role, not completely wipe out the impact of negative balance of trade. We will again read, other parts of current account can play a supportive role in mitigating the overall impact of deficit in balance of trade. Overall impact of the deficit by by partially offsetting the same. Thanks for watching. If you like our course, please spare some time to give a star rating to our course.